Well, a quick comment now from our guest, Marty Fridson of Fridson Investment Advisors. Marty, I guess the question that really comes to mind right now is this a good time to be investing in the stuff that you pay most attention to most closely, which is namely high yield? It was a brutal month for June. It's been pretty volatile since the beginning of the year. You had big declines in the first quarter. You had a rebound in April after the Fed came in to help out with Bear Stearns and Wall Street in general. But now we've seen these declines again in June, and we were just talking about the high yield loan activity there the last week. So it's quite a rocky market. I guess if you're looking at it, it depends on how you're looking at it. Let's start with if you are not a distressed investor, and then maybe we can go on and talk a bit about how you're looking at it from your new perspective.
Yeah, the high-yield market as a whole has been remarkably volatile, as you described. And those moves, we started at about 600 over. The spread on the index got as wide as approximately 850, back to 650, now back to 750. And this is in sharp contrast to the last cycle. In 2000, when we were at a comparable point in the cycle, every single month the spread widened. There was none of this up and down the way we're seeing this year. So that makes it a pretty treacherous kind of a market, even for the pros.
But is that to say that the treachery means that you should or shouldn't be investing in this market right now? If you were advising, if you were in the role that you've occupied for quite some time as an advisor to institutional clients, what would you be telling them to do right now? Yeah,
you have to be selective right now. It's not yet at a capitulation stage. We really have to be looking at the higher quality paper, the higher points in the capital structure. Still a lot of vulnerability, particularly in the lowest quality debt. The CCC sector way overvalued still, despite all the turmoil that we've seen.
Now, that said, do you apply the same rationale to the perspective of a distressed debt investor? Is the volatility, is the overvaluation, say, in the stuff way down on the credit quality stratum CCC paper, stuff to steer clear of, or do you see some attractive opportunities as a distressed investor where you're really looking to recover value there?
Right. We're starting to see a definite pickup in defaults, and the trailing 12 months number that everyone focuses on is only up to 2% from 1%, but year to date, annualized is really already up in the 4% range. So the number of defaults is up a lot more than I think is generally perceived. So that starts to create some opportunities, but at the same time, there's been some concern about a lot of money on the sidelines. There's been fundraising for distressed investing for quite a while in anticipation, and as it turned out, a little bit too early. So there's some concern on that front, and I think we're going to need further escalation in defaults to get to the point where people really feel there are a lot of bargains lying around.
Okay, Marty, let's hold those thoughts for a moment. To do is go straight back to our guest, Marty Fridson, the founder and chief executive officer of Fridson Investment Advisors. For a little reaction, Marty, on Paulson's speech, you have some definitive views on when and where government regulators should step in to interfere in financial markets, or at least from a regulatory standpoint, from a policy-making standpoint. Here, obviously, the Fed, the Treasury Secretary are wrestling with very difficult questions. What do you think of the idea that an extraordinary event would be required for regulators to come in and assume ownership effectively of a non-depository institution, and if taxpayer money were to be put to work, it would have to have, as Lizzie was saying, executive branch approval, effectively a signature from the president?
I think that's the right way to go. You have to set a pretty high threshold for that, because otherwise the risk-taking by the financial institutions really would run the danger of getting entirely out of hand. So I think that has to be there. Now, I can see conflicts arising in the executive branch. Just as simply stated, the treasuries, the secretaries of the Treasury have tended to come from Wall Street. Now, no one's envisioning Goldman Sachs having any kind of problem like that, but you could envision a future situation where you have a Treasury Secretary, even a president, closely identified with an institution that does run into some problems. So then you have some potential conflict there. So it's fraught with a number of potential problems, but nonetheless, I think that establishing that idea, the premise for this has all been, just as historically we looked at depository institutions in a special category and saying, well, if one of those fails, you have repercussions, contraction of credit in the economy as a whole. The argument is that other financial institutions are in a similar category, but you can't very well extend the safety net to them without also making some requirements that they act responsibly and take steps that will limit the systemic risk that they're creating exposure to.
Let's take that idea and really broaden it out. You've been in this market for more than 30 years, really. Some people consider you the dean of high-yield research. What I want to ask you is, We're obviously in this position because of some extraordinary events that have transpired over the past year. But looking back on previous, call it credit crises, credit crunches, what's different this time?
Well, I think the biggest difference in my mind is the acceleration of this process of separation of origination and packaging of structured finance products and the ultimate risk bearing. That's a process that's been going on for some time. We're a long way removed from the days when you got a mortgage at your local savings bank and they held on to it until you paid it off. So we've been going through that securitization process for a long time. But I think in the last few years, that has accelerated to the point where the incentive was all originate, hand it on to someone else, take your fee, and have no residual exposure at all. And that was a recipe for disaster. The disaster hit.
But by the same token, it's created the kinds of opportunities that have effectively allowed you to start a distressed debt investing firm of your own.
Yeah, there is always a silver lining, and we're going to take advantage of that. We're not really in the structured finance and the mortgage market, but we're seeing spillovers. There are corporate credits that will be squeezed very severely by the contraction of balance sheets at the banks, often for reasons nothing to do with corporate exposure, but because they have losses in other areas, and they'll be forced to cut back on an extension of credit generally.
Specifically, where are you looking out? Obviously, we can see what's happening today, but let's say, cast your eyes forward 6 months, 12 months. Which industries do you think on a corporate level are really going to be suffering the most pain, and which, by that token, create opportunities for people like yourself?
Yeah, well, clearly the automotive industry already in major difficulties, and that would include the suppliers. So whether or not you see bankruptcy at one of the big three or not, there spillover effects to the suppliers, the home builders and everything related to that, the housing sector, generally building supply and so forth. It's expanded from that was where the names started to show up as the universe of distressed issuers, non-defaulted, but bonds trading at greater than 1,000 over treasuries. It started there, expanded to the consumer sector, the restaurants, retailers, even the casinos, feeling some of that pain, although they were previously thought to be recession resistant by many who probably hadn't studied their history enough, but there was some support for that, at least in the past experience. The question is to what extent it will and how soon it may start to expand to more general industrial credits.
Marty, hold that thought. We're going to be back in a couple of minutes with Marty Fridson, get some final thoughts on where he's prospecting for opportunities as a distressed investor. You're watching Bloomberg's Open Exchange. It's right now 51 minutes past the hour. Stay tuned.